Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18, and today we're at the office of L&T Infotech.
About 7 years back, we had a great financial crash in the United States, which was mainly because of derivatives trading and a lot of traders, misusing the rules, so to speak. How likely is that to happen with mutual funds? We know that there are regulatory authorities, but despite having regulatory authorities, there were some discrepancies and we had this big crash.
Like you rightly said, Subodh, that last time in 2008, there was a lot of derivative. Now the question is, what is a derivative? It's a little complex instrument which actually helps people speculate, or also has other purposes which are safety and stuff. But if people use derivative for speculation, then you can actually bet very big. That's what some large financial institution did, and that's where there was a lot of financial crisis. Coming to how is that different than a mutual fund, that derivative positions in the US were predominantly speculative positions of the financial institutions, not somebody else's money. In a mutual fund, you're managing a third party's money. If I am a professional, for example, managing somebody else's money, and then there is a regulation on me that I'm supposed to do it only use derivatives only for example, in Indian context, you can only use derivatives for hedging purposes. You can't use it for speculative purposes. There are so many do's and don'ts with respect to regulation specifically on derivatives on mutual funds. You can buy derivatives, you can buy options, but can't sell options. Okay, so the point here is, there they were taking speculative positions on their own money, especially on their proprietary money. Here there is somebody who is managing monies of somebody else with some regulator overseeing their process, and also in the ground rules it's very clearly laid out, and that gets checked and reported, if not higher frequency, at least on a monthly basis. So that risk of getting that done in a mutual fund is a very, very low risk.
My question is, how does this mutual fund utilities and common account number works?
It is one of the ways in which you can invest. So MF Utilities is a platform which has been promoted by all the mutual fund companies together. Okay. The idea is that once you get what is called a common account number from the MF utility, right? You will be able to invest across any schemes at the click of a button online. It helps you take you online. It helps you redeem online. You can change, suppose your bank accounts change. If you change that at one place, automatically it will get linked to all your existing investments as well as new investments. It's a way of making your investments convenient, faster, lower cost. I think those are the three things. So that is one platform. There are other platforms which offer similar facilities. So I mean, it's one of the platforms that have sprung up recently to help investors do their investments cheaply and conveniently and at a lower cost.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18, and I have two very special guests, Harsh Roongta and Feroz Aziz. Harsh, I want to talk to you about gold. People are still curious about gold. Is it a good option? E-gold, not e-gold? Basically, yes, is it a good idea to buy gold now, or has it reached its peak and it's not going to go up much now? What's your view on that?
I think before I answer that, I think it's what is in order is what is gold. And I think there are a lot of, although at the risk of sounding sexist, there are a lot of women in the audience. Investing in jewelry is not gold. Okay, because when you take the jewelry out of the showroom, 30% is gone. You take it out of the showroom, maybe 20 is gone, depending on where you buy it from. So that is not clearly gold. So if at all we are talking comparison, when you say you are investing in gold, physical gold would be say a coin or a bar, that is gold, versus buying it electronically, buying a investing in an ETF for a gold fund or buying some other versions of gold. I think as far as gold is concerned, we have these two schemes on the anvil. Or as far as for fresh investment, it is really going to be the gold bond scheme.
Right.
And I think from the looks of it, more details are clearly awaited. But I think from the looks of it, the gold bond scheme clearly is going to be fairly attractive. I think the fear that I have is that it will be too attractive.
My question is, considering that gold has given negative returns in last 2 years, and due to China crisis, it's expected that future will also be uncertain. So do you still suggest to invest in gold ETFs? If yes, then what should be a percentage?
So I think any asset class, there needs to be a balance. You cannot look at what has happened over the last 2 years and 3 years and keep shifting your investment strategy. I think you need to plan your overall investment strategy. And I think when you plan your overall investment strategy, gold will always have a part. Okay? As long as it has a part that is commensurate with your needs. So typically, I think for any client, we would say 5% to 15% of your portfolio should be in gold. That's one. Second, it should not be built one time. You should not just pay money and take that ETF at one time. Like equity, because gold prices are volatile. Like equity, we recommend that you should buy systematically over a period of time. Similarly, gold should be bought systematically over a period of time. So you don't really need to worry about the China crisis or whatever. I mean, the idea is that when you invest systematically, you insulate yourself from a lot of noise as long as you're doing it over a period of time.
Yeah, my question is that is how to build a mutual fund portfolio. That is how much I should invest in balanced, how much I should invest in equity, mutual funds, fixed income.
Yeah. See, that's practically the last step of your financial planning. It is not the first step. First, you need to see what are the goals I have, which I want these financial instruments to meet. That is the first step. There are two types of goals, one which you have to meet. There are some goals which you can do without meeting in a lifetime. Doing a world tour might not be the most necessary thing, but getting your child educated, getting him married if required, getting your retirement corpus in place, all those are need to have kind of goals. So first, laying down your goals is the first step before you get to mutual funds. After you do that, factor in for price rise, which is also called inflation, because money value depreciates significantly. So the next step is inflation. To put things in perspective, 30 years back, whatever 100 rupees you had is just worth 6 rupees today. So 95% of the value of the 100 rupee note has now become 6 rupees. So first step is goals. Second step is factor in price rise. Third step is choosing the right instrument or the pathway which will help you beat your goal. When you finish these two successfully and deliberated and introspected significantly on these, and there's huge attention to be given on those, once you have a freeze on that, then you move to the third logical step of creating a portfolio. To do what is the most important question. If that is answered, now coming to, for example, if you have goals which are long term, your portfolio should ideally be skewed towards equity, because equity is one of the two asset classes which over long periods of time can beat price rise and do better than inflation. Okay, so then you at least should have 70 to 80% of your money in equity, okay, if those are long-term goals, and about 20% in debt instruments and some degree of gold if you have a allocation which needs to be given. So in the mutual fund category, you need to have gold, debt and equity all in the mutual fund basket, out of which you can actually buy golds also as a gold fund.
Thank you so much, Harsh, for being here. Thank you, Feroz, for being here. Thank you so much for having us here.
This basically in the mutual fund section where of course my knowledge was very limited. The basic factors of evaluation is something that I've learned from here, and one important thing which I'm going to take away from here is investing in my retirement plan.
The show was wonderful. We got good answers. They covered all the possible topics, and yeah, it was really useful tips from the experts. And I like the way they got a 360-degree view of the mutual fund industry.
Before attending the show, I myself did not know much about mutual funds at all. And now, just 2 minutes back, I was guiding someone who couldn't attend the show about mutual funds. So fantastic. The answers are very crisp, which are seldomly found, like, the answers to the queries. Very crisp, too good.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But before we go, here's a chance for you to tell us how much you've learned on the episode.
A person who's interested in stable and diversified investments can grow his or her savings by investing in which asset class? Shares, gold, mutual funds, all of the above. Send in your answers on fwq@network18online.com.
So be sure to send in your answers to the viewer question. Until next week, from the entire team, many thanks for watching.